Bull Bear Buzz Podcast for decoding markets, fueling minds.
Welcome to this deep dive, tailored just for you, the learner. We're looking at a really fascinating snapshot of the markets and some global economic currents as of Wednesday, April 16th, 2025.
Quite a lot happening.
Definitely. You've shared a really interesting collection of articles. We've got Indian stock market movements, gold prices hitting, frankly, record levels, the ongoing U.S.-China trade situation, and some pretty significant shifts in the Indian automotive market.
Yeah, a lot of moving parts.
Exactly. So our mission today is really to unpack these interconnected events, pull out the key insights so you can quickly grasp what's going on and maybe more importantly, why it matters for understanding the bigger picture.
Absolutely. It's about connecting those dots, seeing how these different pieces fit together, gives you a clearer view of the whole landscape.
So let's dive right in. The Indian stock market first. We have reports detailing how the Nifty 50 and Sensex indices, well, they managed to finish the day positive, actually reversing some earlier dips.
That's right. Bit of a turnaround.
And the banking sector seems to have played a pretty crucial role here. So what were the main factors driving this recovery? And what should you, as someone really focused on market dynamics, take away from this?
Okay, right. Let's unpack those numbers. So the Nifty 50, it closed at 23,437.2 I. That's up 0.47%.
Okay.
And the Sensex ended at 77,044.29, which is a 0.40% gain. Now, what's notable here is, despite some of that intraday volatility, the price swings within the day, often driven by short-term news.
Always keeps you on your toes.
Exactly. But the broader market, it actually shows some underlying strength. We saw more stocks gaining value than losing. And importantly, the Nifty Mid-Cap 100 and Small Cap 100, they also posted positive results.
So not just the big guys.
Precisely. It suggests a recovery and maybe a return of investor confidence across a wider range of stocks after maybe some initial uncertainty. This kind of resilience, especially when things look shaky earlier, could hint at a strengthening of India's domestic economic fundamentals, perhaps.
That's an interesting point. Broader market participation. Now, you mentioned banking as a key driver. IndusInd Bank specifically had some good news, it seems.
Yeah, that was quite significant, actually.
What happened there, and how did that sort of ripple through the sector?
Okay, so here's where it gets particularly noteworthy. IndusInd Bank, its stock price surged pretty significantly after the findings of an external probe were released.
The investigation.
Right. This probe was looking into some discrepancies tied to their derivatives portfolio. And the key finding was that let's say the anticipated negative hit to the bank's net worth was actually smaller than people initially expected.
Okay, so better than feared news.
Exactly. The report pointed to a negative impact around 1,979 crore. The bank itself assessed that as a 2.27% adverse effect. Clearly, investors welcomed this. It brought a sense of relief and really boosted confidence, specifically IndusInd.
And I imagine that positive feeling wasn't just limited to IndusInd. Did it lift the whole banking sector?
It really seemed to, yeah. The positive news surrounding IndusInd seemed to create a more favorable outlook for the banking sector overall. The Nifty Bank Index that tracks the major banking stocks, it saw a significant jump. 1.4%.
Wow, 1.4%. That's substantial.
It is. And we saw positive contributions from other big players, too. Axis Bank, HDFC Bank, ICICI Bank, they all closed in the green. It really just highlights how company-specific news, especially in a crucial sector like banking, can have a much broader ripple effect on market sentiment.
So we have this domestic news pushing the market up, despite what the reports called weak global cues. And those weak cues were mostly down to the U.S.-China trade tensions escalating again, right?
It's a really crucial distinction to make, yes. While the Indian market had this positive momentum, there were definitely headwinds blowing on the global front. Primarily, yes, stemming from that increasing friction in the U.S.-China trade relationship.
So the fact that the Indian market seemed to, shrug these off suggests domestic factors were just more powerful that day.
It certainly suggests they were holding stronger sway for Indian investors on that particular day, yeah. Domestic factors seem to outweigh the global concerns for a change.
And one of those key domestic factors, it seems, was the encouraging inflation data. CPI, consumer price inflation, cooled to 3.34% in March. How did that play into the market recovery, especially for banks?
Well, connecting this to the bigger picture, that easing CPI is quite significant. Lower inflation, It can create an environment where the central bank, the RBI in this case, might feel more comfortable thinking about more accommodative monetary policies.
Meaning interest rate cuts.
Exactly.
Yeah.
This cooling CPI has basically fueled speculation that the RBI might go for deeper interest rate cuts down the line.
Right.
And lower interest rates, well, they can be a positive for banks. They can potentially stimulate borrowing and lending, which is, their core business. So the expectation of these potential future rate cuts seems to have given banking stocks an extra little boost. Lower inflation might lead to lower borrowing costs, making loans cheaper, potentially boosting economic activity, hence, good for banks.
Okay, that makes the interconnection much clearer now. Good news for a specific bank, plus the prospect of lower rates.
Yeah, much better handle on the recovery. But, as always, there's a note of caution in the reports. Experts are saying, maybe don't read too much into this 3-day winning streak.
Yeah, and that raises an important point about sustainability, doesn't it? While the market showed resilience, recovered its losses, the experts are probably right to urge a bit of caution. As one strategist pointed out, the current market calm might be, well, a little misleading. It's likely premature to just conclude that long-term stability is back for good, or that, it's just onwards and upwards from here.
Because those global uncertainties are still there. Exactly. Those trade tensions we talked about, they're still very much present. It suggests we could absolutely see more volatility ahead. It's a valuable reminder, I think, for you, the learner, that short-term trends don't always signal long-term stability.
Absolutely. Good point. And just delving a bit deeper into individual stocks, we saw a notable number hitting both their 52-week highs and lows. What can we kind of glean from that sort of divergence?
What's particularly interesting there is the snapshot it gives you of the varying performances across different sectors and companies. The fact that 78 stocks hit their 52-week highs, including big names like HDFC Bank and Party Airtel, that suggest positive momentum, investor confidence in those specific firms, maybe their sectors.
Right.
But conversely, the 30 stocks hitting 52-week lows, like Sheila Foam, that indicates those businesses are facing some real challenges. This kind of divergence just underscores that the market isn't, one single thing moving together.
Yeah.
Different parts of the economy have different realities, different investor sentiment.
And just on a broader level, the total market capitalization of firms listed on the BSE went up quite a bit in just one day. That's a tangible impact for investors, isn't it?
Oh, certainly. An increase in overall market cap translates directly to a rise in the total value of all those companies listed on the Bombay Stock Exchange. In this case, the increase was around 3 lakh crore in a single day. That's a substantial gain in wealth for investors holding those shares. It's a pretty clear indicator of the positive mood by the end of trading.
Now, looking ahead a bit, an analyst, Rupak Dey from LKP Securities, highlighted some key technical levels for the Nifty 50. What are those, and how might they be useful for you in, say, tracking the market's near-term direction?
Okay, so according to Rupak Dey, the Nifty 50 has a crucial support level currently at 23,300. The thinking is, as long as the index stays above this point, the expectation is for continued positive sentiment.
Okay, 23,300 is the floor for now.
Kind of, yeah.
See.
But he cautions if the Nifty decisively drops below 23,300, that could potentially trigger a correction. The next targets might then be around 23,150 and then maybe 23,000.
And on the upside?
On the upside, he identifies a resistance level at 23,650. So these levels can act as important signposts, for understanding the likely near-term path. If support holds, the upward trend might continue. If it breaks, we could see a pullback. If it breaks through resistance, that could signal more gains. Watching these levels can be a valuable indicator for you, the learner.
Okay, some really key levels to keep an eye on there.
Yeah.
Now, shifting gears a bit, while the stock market saw this recovery, another asset class was absolutely grabbing headlines. Gold.
Oh, yes.
Reaching a lifetime high, hitting an incredible 95,000 per 10 grams on the MCX. What on earth was driving that surge, and how does it contrast with what the stock market was doing?
Well, the story with gold is quite distinct, isn't it? And it really underscores the role of these safe haven assets during uncertain times.
Right.
This surge to a record high was really propelled by a mix of factors. One, a weakening U.S. dollar that makes gold cheaper for buyers using other currencies, boosting demand. But more significantly, those escalating trade war tensions between the U.S. and China, plus broader worries about global economic growth linked to these trade disputes and U.S. tariff plans, it all led investors to seek out safer places to park their money, like gold.
The classic flight to safety.
Exactly. International gold prices did the same thing, also hitting record peaks. It's that classic investor reaction when economic and geopolitical uncertainty ramps up.
It's that familiar pattern, isn't it? When other things look risky, people flock to things perceived as stable. And the numbers for gold, even over the last few years, are quite something.
They really are. The fact that MCX gold prices have more than doubled in just the past 4 years, I think it was around 47,000 back in May 2021, that really underscores this longer-term trend. Gold being seen as a reliable hedge against volatility, a dependable store of value, especially when the global environment feels uncertain.
Right.
And analysts have noted the fact that gold has broken through previous resistance levels suggests there might even be potential for more upward movement, at least in the near term.
Fascinating. And speaking of the U.S.-China trade war, which seems to be fueling so much of this, the tensions really look like they're intensifying again. We saw some pretty major announcements from the White House.
Yes, definitely an escalation.
What exactly is happening there, and how does it, connect back to everything else? It feels like those weak global cues the Indian market ignored are precisely what's driving gold up.
You've hit it exactly. That trade relationship is such a critical backdrop. So the White House announced that China now faces significantly higher tariffs, up to a huge 245% on some imports into the U.S.
245%.
Massive, yes. And it's framed as a direct consequence of China's own retaliatory actions against earlier U.S. tariffs. It represents a really substantial step up in this ongoing dispute.
And it wasn't just tariffs, was it? There was also that executive order about critical minerals.
Correct. At the same time, President Trump issued an executive order telling the Secretary of Commerce to investigate the national security risks linked to the U.S. relying on imported critical minerals.
Which basically means China, right? Even if not named.
Well, China wasn't explicitly named, but it's widely understood they dominate the global production of many of these minerals, things essential for defense, energy, EVs, you name it. So this investigation, it could pave the way for more trade actions later. Remember, China had already put export curbs on some rare earths before in response to U.S. tariffs.
Right, it's a tit for tat that just keeps escalating. So that's the U.S. side. How has China responded to these latest moves?
China's been quite vocal, criticizing the U.S. approach. Their foreign ministry's spokesperson basically said mutual respect and equality are essential for trade talks, and the U.S. needs to stop its maximum pressure tactics if it really wants dialogue. And separately, China's defense ministry also weighed in, criticizing the U.S. plans for a big jump in defense spending. They called it bellicose, and criticized what they see as reliance on hard power. These exchanges just show that tensions are broader than just trade now, touching on geopolitics.
Definitely feels that way. But amidst all this conflict talk, there was a temporary sort of pause for some countries, including India.
That's right. In what looks like maybe an attempt to de-escalate things with some trading partners, President Trump granted a 90-day pause on those higher tariffs for 75 countries currently negotiating trade deals with the U.S. India is one of them.
Ah, okay. So a bit of breathing room.
A bit, yeah. And this temporary pause seems to have played a part in that recent recovery we saw in global markets, including India. It might have sparked some renewed interest from foreign investors, and it's a big sect. But it is temporary. The fundamental U.S.-China tensions are still very much there.
Right. Underlying issues aren't resolved. Okay, now, let's shift completely. Another sector highlighted in your materials, the learner. Something pretty dramatic is happening in the Indian automotive market. The types of vehicles people are buying seem to be changing fundamentally.
Oh, absolutely. A huge shift.
What's the big trend we're seeing there? It feels like more than just preference, maybe reflecting deeper economic changes.
It really does. The Indian auto market is going through a major transformation in what consumers want. Demand for small cars, which, were historically the absolute backbone of the industry there, has actually fallen to a 15-year low.
15 years? Wow.
Yeah. Their market share has shrunk substantially. It's mainly because demand for those entry-level compact cars, once so dominant, has just dropped off.
So if not small cars, what is taking the lead now?
It's the utility vehicle segment.
Yeah.
The UVs. Mostly SUVs. That's now the most favored vehicle type in India, by far. It currently commands something like 65% of the domestic passenger vehicle market.
65%? That's huge.
It is. We've even seen several manufacturers completely pull out of the small car segment altogether just to focus their resources and investments on the more profitable SUV market. Models like the Hyundai Creta, Mahindra Scorpio, Tata Punch, Maruti Brezza, they're really leading this charge.
So what's driving this big swing towards SUVs? Is it just fashion, or are there other factors?
It's a mix of things. Easier access to financing definitely plays a role, makes larger vehicles more attainable for more people.
Okay.
There's also clearly rising consumer aspirations. Buyers increasingly want vehicles with more features, more space, a more premium feel, things SUVs often deliver. Plus, the average selling price of cars in India has gone up quite a bit recently, suggesting people are willing to spend more for these types of vehicles. Some analysts also think that with rising safety rules and expectations, it's just getting harder for small cars to offer a really compelling package at a super low price point anymore.
Fascinating. A market built on affordability shifting towards features and size. Now, what about the overall growth of the passenger vehicle market itself? Is it booming?
Well, despite this big internal shift towards SUVs, the overall passenger vehicle market, cars and SUVs combined, actually saw only modest growth last fiscal year, around 2% year-on-year.
Only 2%. That sounds low.
It was actually the slowest growth rate in 4 years. And looking ahead, manufacturers are projecting a similarly moderate growth rate for the next fiscal year. They're pointing to things like lower household incomes, maybe less consumer optimism, higher prices, and just general inflation as potential headwinds.
Okay. So internal shifts, but overall growth is sluggish. What about Maruti Suzuki? They've dominated the small car space forever. How are they coping with this trend?
That's a really crucial question. Maruti Suzuki, they still get a huge chunk of their sales from the mini and compact segments. They actually recorded pretty much zero growth last fiscal year.
Zero growth from Maruti?
Near zero, yeah. They are actually hoping for a comeback in demand for small cars this coming year. They're banking on an improvement in rural spending potentially helping. Their management has previously blamed the decline on prices just rising too much, making small cars less affordable.
So they're hoping the rural economy can save the small car.
That seems to be the hope, yes. Reignite some of that demand. It's definitely a contrasting outlook compared to others who are actively pivoting away from small cars.
Interesting strategy difference. Okay, finally, let's touch on foreign institutional investors, FIIs. We saw that after quite a long selling streak, they actually made a significant purchase of Indian equities recently. Why might that be? And is this likely to stick?
Yeah, FII activity is always a key indicator, isn't it? After selling Indian equities for 9 straight days, they did make a substantial purchase. There could be a couple of reasons for this turnaround.
Okay.
One possibility is something called short covering. That's when investors who bet against stocks buy them back to close their positions, maybe limiting losses. That can temporarily push prices up.
Right. Technical buying.
Could be part of it. Another potential driver is that temporary pause on U.S. tariffs we discussed. That might have created a slightly more positive, if short-term, outlook for global markets, including India, making Indian stocks look a bit more attractive to foreign money again.
So a potential shift in mood, but maybe temporary. Is it sustainable?
Exactly. That's the big question. Analysts are generally advising that these FII flows are likely to stay volatile. Things like where the U.S. dollar goes, overall global market developments, they'll continue to have a big influence. Remember, before this recent buying, FIIs have been net sellers for quite a while. They were citing worries about high valuations in India and those global growth concerns, including U.S.-China tensions. So, while this recent buying is a positive signal, whether it marks a sustained change in their strategy, well, that remains to be seen.
And what about domestic investors? DIIs.
Domestic institutional investors, DIIs, they've generally been a bit more cautious lately. Seems they share some of those same concerns about U.S. tariffs and maybe high domestic market valuations.
Okay, a more cautious local view, perhaps. So the learner, wrapping this up, as you can clearly see, the whole landscape market, global economy, it's incredibly intricate, deeply interconnected.
It's definitely complex.
Today's deep dive really paints a fascinating picture, doesn't it? We've got a domestic stock market finding its feet again, helped by banking sector recovery and maybe easing inflation, even while those global trade tensions are simmering and gold is hitting unbelievable highs. Plus, we've explored that huge evolution in the Indian auto market and a tentative, maybe fragile, return of foreign investment.
And what's truly striking, I think, is that constant interplay, local versus global forces. The Indian market showed some real resilience against international headwinds, which says something about its domestic drivers right now.
Yeah.
But then that massive surge in gold prices, it's a powerful reminder of how global uncertainty and geopolitics always impact investor behavior. Always.
Can't ignore it.
And that dramatic shift in the auto sector, it just underlines how fast consumer preferences and economic realities can change. And the often unpredictable nature of foreign investment just highlights how sensitive markets are to global events and policy shifts.
Which really brings up a crucial question for you, the learner, to think about. How might all these different trends, the stock market rebound, the gold surge, the US-China dynamics, the auto market transformation, how might they ultimately influence each other in the coming months, maybe even years?
That's the million-dollar question, isn't it?
It really is. What indicators will you be watching to gauge the longer-term impact of these forces colliding? This is truly just the start of understanding these complex dynamics, and we really hope this deep dive has given you a valuable framework for your own ongoing exploration.